gold and silver are once again dominating global financial headlines, and this time the stakes feel significantly higher. After months of steady gains and record-breaking rallies, both metals have entered a period of sharp volatility that has left investors confused. Prices surged aggressively on safe haven demand, then suddenly corrected with surprising speed. This rapid shift has created uncertainty across markets, raising a critical question. Are we witnessing the end of the precious metals rally, or is this simply a temporary reset before a much larger breakout? To understand where gold and silver may be heading next, we must first analyze the forces that pushed them higher in the first place. Over the past 3 years, central banks around the world have been accumulating gold at one of the fastest paces in modern financial history. Countries across Asia, the Middle East, and Eastern Europe have been increasing their gold reserves as a strategic response to rising geopolitical tensions, currency volatility, and growing concerns over sovereign debt levels. This accumulation is not emotional buying. It is institutional positioning. Central banks do not chase short-term price momentum. They prepare for structural shifts. With global debt levels exceeding historical records and fiscal deficits expanding across major economies, confidence in fiat currencies has weakened. Gold, as a non-yielding but scarce monetary asset, becomes increasingly attractive in such an environment. At the same time, inflation remains persistent. Even though headline inflation numbers have moderated from their peaks, underlying price pressures in housing, energy, and services continue to strain consumers. Central banks face a difficult dilemma. If they maintain high interest rates, economic growth slows further. If they begin cutting rates, inflation risks reigniting. This policy trap creates uncertainty, and uncertainty fuels demand for safe haven assets like gold. Recent market volatility has been largely driven by shifting expectations around interest rate policy. Investors are attempting to anticipate when the Federal Reserve and other major central banks will begin cutting rates. If rate cuts materialize sooner than expected, gold could benefit significantly due to a weaker dollar and lower real yields. Historically, declining real interest rates have been one of the strongest catalysts for sustained gold rallies. Many institutional analysts are now projecting that gold could test the $2,800 to $3,200 range if rate cuts begin during 2026. In more aggressive scenarios involving renewed inflation or financial instability, some forecasts even extend beyond $3,500 per ounce. While such projections may appear extreme, they are rooted in historical precedent. During periods of monetary expansion and currency debasement, gold has consistently revalued higher. Silver, however, introduces an additional layer of complexity. Unlike gold, silver is both a monetary metal and an industrial commodity. Nearly half of global silver demand originates from industrial applications, particularly in solar energy production, electric vehicles, and advanced electronics. As global investment in renewable energy accelerates, silver demand continues to rise. At the same time, the silver market faces ongoing supply deficits. Mining output has struggled to keep pace with rising demand, particularly as ore grades decline and environmental regulations increase operational costs. Analysts expect the silver market to remain in structural deficit for multiple consecutive years. This imbalance between supply and demand forms a powerful long-term support base for prices. Despite these supportive fundamentals, silver remains highly volatile. Its market size is significantly smaller than gold's, which means capital flows can produce exaggerated price swings. When investor sentiment turns positive, silver often outperforms gold on a percentage basis. However, during risk-off periods, silver can decline sharply due to its industrial exposure. This dual nature makes silver both attractive and unpredictable. In a scenario where global growth stabilizes while monetary policy eases, silver could benefit from both investment demand and industrial expansion. Some analysts project that silver could trade between $40 and $50 in a strong bull market environment. In more extreme bullish conditions, particularly if the gold-to-silver ratio compresses rapidly, silver could exceed those levels. The gold-to-silver ratio remains one of the most important indicators to monitor. Historically, when the ratio reaches elevated levels, it signals that silver may be undervalued relative to gold. As the ratio declines, silver tends to outperform. Current levels suggest that silver retains significant upside potential if broader precious metals momentum resumes. Another factor influencing both metals is geopolitical instability. Ongoing global conflicts, trade tensions, and shifting alliances have increased demand for reserve diversification. Several nations have actively reduced reliance on the US dollar in international trade settlements. While the dollar remains dominant, incremental shifts toward multipolar currency arrangements support gold demand over time. In addition, investor psychology plays a crucial role. Financial markets are driven by expectations and confidence. When confidence in equities, bonds, or currencies weakens, capital flows toward tangible assets. Gold and silver historically perform strongest during periods of financial stress, banking instability, or sovereign debt concerns. However, risks must also be acknowledged. If economic growth slows significantly and enters recessionary territory, industrial demand for silver could weaken temporarily. Additionally, if central banks maintain restrictive monetary policy longer than anticipated, precious metals could experience further short-term pressure. Stronger than expected economic data could also strengthen the dollar, creating headwinds for gold. That said, long-term structural forces remain intact. Global debt levels continue to expand. Fiscal deficits show no signs of meaningful reduction. Political polarization across major economies increases the likelihood of continued stimulus and accommodative policies. Over extended time horizons, such conditions historically benefit hard assets. Another overlooked element is physical demand. In many regions, retail investors have increased purchases of physical bullion as protection against currency depreciation. Premiums on physical silver coins and bars have fluctuated but remain elevated during periods of market stress. This underlying demand reflects a growing awareness of systemic risk among individual investors. Institutional investors are also adjusting allocations. While gold does not produce yield, its role as portfolio insurance becomes more valuable when traditional asset correlations break down. During equity market volatility, gold often serves as a stabilizing component within diversified portfolios. Looking ahead, the base case scenario for 2026 involves moderate economic slowdown, combined with gradual monetary easing. In such an environment, gold is likely to trend upward steadily, potentially establishing new all-time highs. Silver may experience sharper swings but could deliver stronger percentage gains if industrial demand remains resilient. A more aggressive bullish scenario would involve renewed inflation pressures or financial instability within the banking sector. In that case, gold could accelerate rapidly beyond current forecasts, with silver following in amplified fashion. Conversely, a bearish scenario would require sustained high real interest rates and a strengthening dollar, conditions that currently appear politically and economically difficult to maintain for extended periods. Ultimately, precious metals markets reflect confidence in the monetary system. As long as governments continue expanding balance sheets and issuing debt at record levels, gold and silver maintain relevance. Corrections are inevitable within any bull market, but structural demand drivers do not disappear overnight. The recent price pullback should therefore be viewed within context. Rapid rallies often require consolidation phases to establish stronger support levels. Volatility does not necessarily signal reversal, it often signals repositioning. Large institutional participants adjust exposure strategically, and such movements can temporarily exaggerate price declines. Investors should focus not only on daily price fluctuations but on macroeconomic direction. Monitoring interest rate policy, inflation trends, currency strength, and central bank reserve activity provides clearer insight than short-term chart movements alone. Precious metals respond to shifts in liquidity and confidence more than headline noise. As we move deeper into 2026, market participants remain divided. Some argue that gold has already priced in much of the macro risk. Others believe the real repricing has yet to begin. What is undeniable is that structural vulnerabilities within the global financial system persist. Debt expansion, demographic pressures, and geopolitical fragmentation create an environment where hard assets maintain strategic importance. For silver, the story may ultimately hinge on industrial transformation. The global transition toward renewable energy is not a short-term trend. It is a multi-decade shift. Silver's conductive properties make it essential for solar technology and advanced electronics. If governments continue investing heavily in green infrastructure, baseline silver demand could remain elevated regardless of monetary conditions. In conclusion, gold and silver are not merely reacting to short-term speculation. They are responding to deep structural changes in the global economy. While volatility may continue in the near term, the broader trajectory remains influenced by debt dynamics, monetary policy, industrial demand, and investor psychology. The key question is not whether volatility will persist. It certainly will. The real question is whether the structural forces supporting precious metals will intensify or fade. At present, evidence suggests they are intensifying. For investors willing to tolerate short-term fluctuations, gold and silver may continue to represent strategic assets in an increasingly uncertain world. The coming months will likely determine whether this consolidation phase transforms into the next major breakout. As always in financial markets, preparation matters more than reaction. Those who understand the underlying drivers will be better positioned when the next decisive move begins.